The simplest way to start creating income from investments is by investing money into treasury bonds. This is where you lend money to the United States government and they're going to pay you regular interest payments for using your money. Before I show you how this works, let me start with the pros of this, which are number one, it's generally risk-free. If you're lending money to the United States government, it's backed by all the taxpayers and it's backed by the Federal Reserve Bank's ability to print money and lend it to the United States government. Because if the United States government were to default and not pay their bills, that would create a global crisis, and the least of your problems would be your treasury investments that you made. The second benefit is the interest that you generate from these treasury bonds are generally not subject to state taxes, which means you get to keep some more of that income, unlike putting your money into, say, a high-yield savings account. And number three, you can create a new stream of income that can be paid to you monthly. I'll show you how, through these interest payments that you get. But what about the cons? Con number one is you don't get any growth in your principal. So if you lend $100 to the United States government, you're going to generate interest on those $100, but that $100 doesn't actually grow. You're just getting interest on that $100. Number two is you get lower-ish returns because you're capped based off of whatever the interest rate is, and because it's generally risk-free, you're getting lower returns because you're not taking on a whole lot of risk. And number three, this is not FDIC insured. You have no guarantee that the government's going to pay you. It's just the promise that the United States government is going to pay you. So how do you do this? Well, you can buy these treasury bonds directly from the United States government by going through Treasury Direct, or an even simpler alternative would be to invest your money into a treasury bond ETF like SGOV. This is an ETF that's investing in treasury bonds, meaning lending money to the United States government with loans that are going to mature in 3 months or less. And at the time of recording this video, SGOV is paying out an annual dividend of around 4.7%. But this is the part that you have to remember. When you're investing in treasury bonds, even a treasury bond ETF, you're not investing for growth of your principal. So what you'll see is that the SGOV ETF price really doesn't change. I mean, the only time it goes up and down is when it pays out the dividend, because the stock price will fall by the amount of the dividend, but the stock price, the ETF price, stays the same, and then you get this interest, which right now is around 4.7%. It's paid monthly, but the way that you get paid is through that interest. So this is a relatively simple way to create monthly income that's generally pretty stable, and it's backed by United States treasuries. Again, the difference between this and putting your money into a high-yield savings account is even with this ETF, if you invested your money here, you're generally not going to be subject to state taxes, versus with a high-yield savings account, you're going to be FDIC insured, but you will have to pay the federal and the state taxes with that. And of course, you should also be aware that the interest rate that these treasuries will pay will depend on what the Federal Reserve Bank is doing. So if the Federal Reserve Bank cut interest rates, well, these treasury interest payments will also probably fall, but that's a topic for a different video. Asset number two, which is a little bit more advanced, are dividend-paying ETFs. There are some companies in the world, for example, McDonald's, which has the stock ticker symbol MCD, which is making billions of dollars of profit every single year, and then they don't know what to exactly do with that profit. So one of the things that they do is they just give it away to the shareholders. So if you buy one share of the McDonald's stock, you are going to be entitled to your share of profit distribution, which is called a dividend. This dividend is paid out every 3 months, meaning every quarter. The problem with investing in, say, McDonald's or another dividend-paying stock is what happens if McDonald's starts to serve bad burgers? They start to take on too much debt. They hire a bad CEO. They run the company into the ground. And now not only maybe they cut their dividends, but they also go bankrupt. Now, not only did you lose your income, but you also lost your entire investment. Now, it's not a bad thing to invest into individual companies, but that's a little bit more advanced, and you want to make sure you're staying up on your research. This is why the alternative, and a much simpler way to start if you want steady, consistent income without the headache, without all the research, without all the work, is to consider investing your money into dividend-paying ETFs. Now, I got to give you a disclaimer, okay? Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. I'm going to break this dividend section up into 3 different categories. And instead of investing in an individual company, you can invest in a fund, a basket of stocks called an ETF. Now, instead of investing in one company like McDonald's, you can invest in a dividend-specific fund that's giving you exposure to things like, say, high dividend-paying stocks in the United States. And now maybe you're going to get exposure to hundreds, maybe thousands of high dividend paying companies. This way, if one of the companies, say McDonald's, goes bankrupt or really starts to struggle, this ETF will kick that company out and replace it with another company. That way it's completely passive for you and you can continue getting at least some sort of steady of an income. Example number 1, NOBL, Noble. This ETF will give you exposure to S&P 500 dividend aristocrats. What that means is this is dividend paying companies in the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Not all of them are going to pay a dividend. This is going to invest in the dividend-paying companies in the S&P 500, but more specifically the dividend aristocrats, meaning these are companies that have paid out and increased their dividend every year for the last 25 years or more. If you want to get exposure to all those companies, well, this ETF will give you exposure to that. And at the time of me recording this video, Noble is paying out a little bit over 2% a year in dividends. But let's say you wanted to get a little bit more broad. SCHD is an ETF that I'm personally invested in. As a disclaimer, this is created by a company called Schwab, and this is giving you broader exposure to high dividend paying companies in the United States. Right now, at the time of recording this video, it's paying around 4% a year in dividends. Again, the whole idea behind investing in an ETF as opposed to one company is now your work is less because you don't have to keep up with the stock every single day. You don't have to worry about one company going bankrupt, and it's managed by the fund. That way you can just keep working to put more money into the fund. Category number 2 is international dividend paying ETFs. This is a fun one because if we look at the companies overseas, some of these companies are not only growing quickly, but they're also in markets, countries that are also growing. That means some of these companies have the ability to grow faster and pay out bigger dividends faster. But it comes at a risk, because some of these countries are not as stable as the United States. Some of these countries could see more unrest. A couple examples here will be VYMI. Again, disclaimer, this is something that I'm personally invested in. This is a fund created by Vanguard that's investing in high dividend paying companies internationally. Another example is IDV. This is an ETF created by iShares. It's a different fund manager, and this is their Select International Dividend Fund. At the time of me recording this video, VYMI is paying around 4% a year in dividends, while IDV is paying around 5% a year in dividends. And then we have the third category, which are the real estate ETFs. Now, I want to remind you that for those of you that are investors and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, housing, stocks, crypto, and the global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you sign up for Market Briefs, you'll also get my investing masterclass as a bonus, where I will walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. All of this is completely free. So if you want to get Market Briefs and my investing masterclass, all you have to do is click the link down in the description below. REIT stands for Real Estate Investment Trust, and this is where you're getting exposure to the real estate market without actually going out and buying the properties yourself. Now, there's a couple ways that you can invest in REITs. One type of REITs are real estate REITs. The other kind are mortgage REITs. A real estate REIT is where you're investing into a company that's actually buying property. Whether it's apartments, offices, hotels, it's buying actual physical property. A mortgage REIT is where this company is going out and investing in the mortgages, the loans that are backing the real estate. Here's a couple examples. VNQ is a popular ETF created by Vanguard that will give you exposure to the real estate REITs. These are companies that are actually buying the physical properties. REM is a REIT ETF that gives you exposure by iShares to the mortgage REITs. Right now, at the time we're recording this video, VNQ is paying around a 4% dividend a year, while REM is paying around 9.5% dividends a year. Now, the 9.5 number is going to look very attractive, but it's also a much more volatile market. So when you make your investment decisions, when it comes to dividend ETFs, the one factor you don't want to make your sole decision off of is the dividend. I get it. You're investing for income, but you have to look deeper than that. Understand what is the assets that you're investing in, because you can get a high dividend, but if the asset is crap, then the value of your asset's going to fall and your dividends will fall with it as well. That's why you want to make sure you're investing in good assets that are paying strong dividends. That way, hopefully, the assets will grow and the dividends will grow with it as well. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.